I'm just going to go through what I consider the major aspect of trading, which are trading psychology, risk management, and money management, and trading strategy. So for me, these are the three most important aspects of trading. And if you're able to master these three aspects, then you would become a consistently profitable trader. And out of all the three aspects that I mentioned earlier, for me, the most important one is trading psychology, and it is extremely difficult to master, but not impossible. And usually, that is what usually separates the consistently profitable traders from those who consistently lose money. Um, and you would realize that even if you're using the same strategy as another person, one person may end up being more profitable than the other, or the other may not even be profitable at all, and will think that the forex strategy that he or she is using, yeah, it's not working. But most of the time, it has to do with psychology. And one of the aspects of psychology I'm going to touch about quickly would be discipline. Discipline in how you take your trades, how you follow your strategy, whatever strategy it is, and making sure that no matter what is happening in the market, that you follow your strategy to the T. Even if the trade doesn't play out, that's just one trade lost. Next setup, follow your strategy according to your plan. And one thing that I'll mention later on in the video will be about having a good trading plan. I've made a video about that in the past. I would link it to this video so that you can go watch that as well. Having a good trading plan and following through with that trading plan takes a lot of discipline, and it is one of the things that makes a consistently profitable trader. Discipline. Most traders who aren't profitable are not very disciplined at all, and they do not follow this trading strategy. Anytime something doesn't work for them, they end up just abandoning it and just moving on to the next strategy, and they just end up taking changing strategies over and over and over again. And the second thing that I would like to point out would be patience. Patience in forex trading is extremely, extremely important. And what I always tell my friends is, if you actually want to know if you're a patient person or not, is to try forex trading. Because once you place a trade, and depending on sort of strategy, the type of trader you are, if you're a swing trader or a day trader or a scalper, you know, like scalpers, for example, can't swing trade because you're not patient enough to wait for their trades to move for a very long time, and after a few minutes or hours they end up taking their trades out. And if you're not patient enough, then I wouldn't encourage you to swing trade or day trade. Then you can try um scalping. But being patient enough for the trades to play out, being patient enough to wait for price to get to where you want it to get to before you take a particular trade is very important. Sometimes you expect that, okay, you know what, I think price is going to go up to this level. When it gets to this level, this is what's going to happen. Then when price starts heading to that level, you're like, oh yeah, price is now heading to this level. Let me just enter a buy trade so that when price gets to that level, I would, I would exit the trade. What if price never gets to that level? What if it starts falling from immediately you enter that trade? So that's why it's extremely important. If you identify any area, stick to it. If price doesn't get there, fine. Do your analysis all over again and pick a good entry to enter. And make sure that you exercise patience. Extremely important. The third part of trading psychology, which most people feel with, is grade. When people start getting greedy, that is when they'll end up blowing their accounts. So, for example, you start trading and your first trade was profitable. You gain, maybe you start with a very small lot size of 0.01, and you ended up getting like maybe 10, 20 pips, you earn like $2. Next trade, you end up getting like 40 pips, $4. The next trade, you end up getting like, you've been earning some profits, maybe using a small account like $100 or $200. Now you're thinking, oh, I'm making money. every trade that I take has been profitable. Why don't I increase my lot size so that even if it moves small, maybe like 10, 20 pips in my direction, I would, instead of making like $10 or $20 or $1 or $2, I would make like $20. You end up increasing your lot size and price goes in the opposite direction, hitting your stop loss, taking you out. Now you've lost more money than normal. You've lost more of your capital than you would normally, just because you were greedy and not following the plan that you've set out to use a smaller lot size, thinking that, oh, because you've become profitable, or because you've won a few trades, that you can increase your lot size. And the time that you increase your lot size could be the time that the trade goes against you and you end up losing all the profits that you've made earlier. So greed is one of the things that usually would make forex traders not to be profitable. So mastering these three aspects of trading psychology for me are very important: discipline, patience, and for you to be able to curb any sort of greed. Now, one of the books I love a lot is this Trading Psychology by Mark Douglas. And in that book, he listed five fundamental truths about trading. So I'm just going to go through them for you very quickly. Okay. Um, the first thing that he mentioned was anything can happen in the Forex market. And that is very true. If you've been trading for a while, you would know that anything can happen in the Forex market. Even if you've done your analysis, everything seems like it's going to go your direction. Anything can happen. It could be a news from nowhere, maybe an economic news, and that would, or a disaster somewhere that will end up crashing the Euro USD or end up crashing the GBP USD, and price ends up going in the opposite direction from what you have analyzed. So you know that anything can happen, and you should always be prepared for that. And that's why stop loss is extremely important. Okay. Next part is you don't need to know what is going to happen next in the market for you to make money. And that is very true. You actually don't need to know what's going to happen. The thing is, if you have your strategy, you know where you're going to enter or when you're going to exit the trade. Even if price doesn't get there, reanalyze the market. Just look for a particular point where you need to enter or not. And you don't need to know whether price is going to go up or go down, but follow your strategy on where your strategy says enter a trade. If it goes in your direction, perfect. Capitalize on that move, take money from the market, and exit the trade. But you don't necessarily need to know that price is going to go up today or price is going to go down today. You don't need to know that. Forex market doesn't work that way. The third thing you need to know is that there is a random distribution between wins and losses for the variables that define your edge. So your edge is basically your Forex strategy, and there is a random distribution between your wins and your losses, meaning that market would always go in one of two ways: either it would be a buy or a sell. And if you enter a buy trade, it's either it goes in that buy trade or your sell trade. But your edge is what makes, is what gives you that chance of it going in the particular direction that you want it to go. And which brings me to the fourth point, which is my edge is nothing more than indication of a higher probability of one thing happening over another. So it's, first market is one of two ways: either a buy or a sell. And it's either going to go up or it's going to go down when you enter a trade. You can close your eyes, open your MetaTrader or whatever platform you're using, close your eyes and either click a buy or a sell. And there are two ways price can go. You can either go in your direction, you can either go as a buy or a sell. And now, where your strategy comes in is giving you that edge, that higher probability that price is going to go in the direction that you want it to go. And that's basically what you need to know. And the fifth fundamental truth is that every moment in the forex market is unique. So you may see a particular trade that looked similar to what you had yesterday. It doesn't mean that price will play out exactly as it did yesterday, even though you've seen a similar setup that was there yesterday. You understand? So if you took that setup yesterday or the previous day and it was a buy trade, when you saw that particular signal, you took the buy trade, it went in your direction. It doesn't mean that 100% it would go in your direction if you take that particular trade the next day. There is always that probability that it would go in the opposite direction. And again, this is why stop loss is important. So you need to have it at the back of your mind, or of your mind, that every market is unique. You have to be careful. You have to manage your risk when you're entering into the market. So these are the 5 fundamental truths, and I think they're extremely important. And when you start trading, you realize that these truths are very, very true to Forex trading. Next aspect of trading that is important, or the second most important aspect to me, is your risk management and money management. Okay. So talking about risk management, you're looking at your risk to reward ratio. So, and that's basically how much are you willing to risk to gain a certain amount of money. Okay. So if you're going to take a particular trade and you're entering a particular lot size, you're thinking, okay, what am I betting for this trade going in my direction? So if I'm going to take a buy trade on Euro USD, for example, and I put in my buy trade, my stop loss is like maybe like 20 pips, which is probably like maybe $20. And I'm like, okay, that is basically, I'm betting $20 in the hopes that the price will go in my direction. If it doesn't go in my direction, then I lose $20. But if it goes in my direction, then I have the possibility of making more than $20. And where the risk reward ratio comes in, or where it becomes very important, is making sure that you are making more money, or you plan to make more money than you plan to lose. So usually most traders would suggest having at least a minimum risk to reward ratio of 2:1. For me, with the strategy I trade, my minimum risk to reward ratio is usually 1:3. So I'm looking to make 3 times the amount of money that I'm risking. So if I enter a particular trade and I'm looking to risk $20, that means I'm looking to gain about $60. So I am betting $20 to gain $60. That's basically what the risk reward ratio is. If it goes in my direction, I get $60. If it goes against me, I get $20. And where this and why this is very important is, for example, if we take 3 trades, you lose your first trade, you lose the second trade, and you win your third trade. That is losing two trades and winning 1 trade. You lose your first trade, you lose $20. You lose the second trade, you lose another $20. That's $40. You win your next trade because the risk to reward ratio is 1:3. You gain $60. Now $60 minus the 40 you've lost, your net gain is $20. So even though you've lost 2 trades as against 1 trade that you've only won, you've still gained $20. So that is why the risk to reward ratio is extremely important. Again, with risk management, stop loss is extremely important. You always have to have a stop loss because, again, anything can happen in the Forex market and the market can go in the opposite direction. So it's always very important to have a stop loss in place to curb and you blowing your account. And next thing that I would mention again is your take profit. Now, it's very easy for people to place, stop loss and all that. And one thing I have to mention again before I go into the take profit is try not to move your stop loss further down or further up if you're in a sell trade. Once you have placed your stop loss, leave your stop loss there. The only time is you should move your stop losses if you want to break even, so that if the price eventually goes in the opposite direction of your trade, then you'll be taken out at break even and not lose any capital at all. But don't expand your stop loss. Don't increase that. Otherwise, you just be losing more and more money. Okay. Second thing is is the take profits. Now, this is usually a problem for most traders. When they enter a trade, they do not know where to exit the trade. They don't know if they want to hold the trades for longer or for short periods of time, or where do they exit the trades. What if I exit my trade now and the market continues in the direction that I want it to go? What if I don't exit my trade and it market reverses? That it's a lot of problems for people. And when I talk about trading strategy, I'll mention that as well, because you need to know before you take a trade, you need to know or have an idea where you want to exit this trade. You need to know why you are going to exit the trade. If eventually you exit the trade, are you exiting the trade because you feel like the price is reversing? Are you exiting the trade because you know that price has gotten to a significant level where price may eventually reverse. If that's the case, then you exit the trade. But not knowing where to exit the trade is a very, very dangerous thing to do, and you need to make sure that you know where to exit your trade, and that is a very key aspect of risk management as well as money management. Now, what I always tell people is to always take money from the market when the market gives you the opportunity to take money from it. Always take money from the market. So if you enter a trade now, and maybe in the next couple of hours the trade goes in your direction massively, maybe about 20 pips, 30 pips, 40 pips, depending on the type of trader you are. If you enter maybe a lot size of 0.05, for example, take out some money from the market, close some positions. You can close maybe 0.02 out of that position that you've taken. Close 0.02, move your stop loss to break even. So if at any point the market reverses, one, you've taken some money out of the market. Two, you've moved your stop loss. So even if it hits your stop loss after you've broken even, it won't take you out in a loss. Rather, you would have a profit. You may not have as much profit as before, but you will still have some profit. So if you do that consistently, there's no way you will be losing your trade, or there's no way you will be in loss. So always try to take money from the market. So the next thing I'll talk about is the trading strategy, which is the last aspect, and important but not as important as trading psychology and risk and money management. Now, with your strategy is basically your edge over the market, okay? And like I mentioned earlier in the video, there's always two ways the market can go, either a buy or a sell. But your edge is basically the you putting that trade in your direction, the probability of you of the trade heading in the direction that you want it to go to. That is your edge. That is your what your trading strategy is basically about. And risk reward ratio as well is part of a trading strategy. Like I mentioned earlier, it's very important you have a good risk to reward ratio, because even if you're losing a lot of trades, that risk to reward ratio will be what will make you profitable eventually. And now that brings me to the win rate as well. So for me, what I would say is you don't need a win rate of 100% with your strategy. You don't need 90% or 80%. If you have a win rate of 50% with a very good what do you call it, strategy, 50% win rate, and a good risk to reward ratio of at least 3:1, even if you win 50% of the trade and lose 50% of the trade, because of the very good risk to reward ratio that you have of at least 1:3, you would be profitable at the end of the day. Okay, so you don't necessarily need a strategy with a very, very high win rate. And that's what a lot of beginner traders are looking for, a strategy that they would always win. And just sometimes when, a week where you would trade and the market probably wouldn't go in your favor, and you may end up maybe losing like up to 3, 4, 5, 6 trades in that week, but if you have a good risk to reward ratio, your next couple of trades, if they are winning trades, should be able to make up for the 5 or 6 losses that you've had in your previous trades. So that's why the risk reward ratio for me is extremely important. Now, another thing again that most traders don't have, not just beginner traders, but even traders who have been trading for a while that are not consistently profitable, is having a good trading plan and having a trading journal as well. Most traders don't have this, and that is what usually separates the consistently profitable traders from those who are not consistently profitable. If you ask any consistently profitable trader if they have a trading plan or a trading journal, they will show it to you, because it is extremely important. You cannot go into trading without having a proper plan. Because if you don't have a proper plan, you would not have, there wouldn't be any discipline. You wouldn't have that patience, and you would just, be greedy, and everything that negative I've talked about in trading psychology, that's what you will just be exhibiting. And if you've been trading for a while as a beginner trader, you understand what I'm talking about. Before you enter any trade at all, you need to plan your trade. You need to know your strategy is your trading price action. You're using candlestick patterns, you're using chart patterns. support and resistance level, whatever it is. Price gets to your level. What does the trading plan say? Trading plan says when price gets to this particular level and shows me this sort of signal, it's either stochastic or RSI is in the overbought or oversold, or it forms this reverse candlestick pattern. My trading strategy says enter the trade. You enter the trade. Where does your trading plan says? When your trading plan does say, oh, how do I put my stop loss? That has to be indicated in your trading plan. Then you put your stop loss. In your trading plan, you have to indicate how you will normally take your profit. Then you have to make sure that that is what you do, and you leave the trade to play out. As the trade is playing out, if it goes in the opposite direction and reverse and it's not going in your direction, that's fine. Losses are inevitable in the Forex market. There's no Forex trader who's 100% profitable and hasn't lost any amount of money at all. So if it goes in the opposite direction, no problem. You go back to the drawing board, you analyze the market again, and you look for another entry. And if it eventually goes in your direction, note everything down in your trading journal. Why did I take this particular trade? What prompted me not to take that particular trade? Why did I enter this one? Why did I not move my stop loss? Why did I move my stop loss? Why didn't I take profit when price gets here? Why didn't I manage my money properly? Write everything that you feel in your trading journal. That's important, so that by the end of the week, when you review your trading journal and everything that you've gone through, you will know the sort of mistakes that you made, and you will know how to correct them in the future. That's why trading journals are important. And the trading plan is just to guide you, just to make you more disciplined in your trading. And that's why it's important for you to have that. Okay. So these are some of the aspects of trading, or the three major aspects of trading that I would like to share for you, especially for beginning traders. And I feel that these aspects are very, very important. And that's why I want you to know them at the beginning of the year before you go into trading. If you haven't had made a trading plan, I made a video about the trading plan. The link will be in the description. Go watch that video on how to make a trading plan and what the components of a trading plan are. And just make sure that you ensure proper risk management when you're trading, because it's very, very risky. I hope this video has been very helpful to you. If it has, kindly leave a like. And if you haven't subscribed, kindly subscribe to the channel. And once again, thank you so much for 1,000 subscribers. I really appreciate it. And I will see you in the next video. Have a great week ahead. Cheers.